Gagan Banga, the VC and MD at Indiabulls Housing Finance, to discuss their quarterly numbers and more. Gagan, thanks for joining us this morning. Now, you reported weak profitability mainly on the account of higher provisioning for the quarter. So, barring this on the account of macro uncertainties, what were some of the other factors that led to weaker performance this time?
Yeah, so the company has taken a conservative view. We believe that there are definitely certain macro uncertainties which everyone is well aware of, and given the fact that the lockdown has practically continued, even though we are now in undo the lockdown mode, but small businesses, salaried employees, as well as real estate projects, all of them are affected and will slowly come back to life. Given all of that, we've chosen a conservative view, created large provisions. Currently, provisions are as high as almost 5.5% of our loan assets. We are effectively a zero net NPA company. We carry around 2,500 crores of excess provisions, so a large amount of buffers have been created. The company is also coming through what is called as the NBFC crisis, which is now almost a 2-year-long crisis which has been going on. And on that front, I think the last 6 months have been tremendously good in terms of turning. So given the situation and the hope that the company has that from second half of this year we should be back on growth mode, we thought it is better to take this pain one time, create these large provisions so that we can get back to focusing on business and growth and try and get to our growth targets starting second half of this year.
How many of your customers, Gagan, opted for a moratorium, and have the recovery rates improved as the economy has been unlocking? Also, what's been the behavior of non-delinquent customers as well? Any changes that you're seeing there?
Yes, the delinquent customers are a very, very small percentage of the company. It is, our gross NPLs are all of 1.8%. The teams have engaged actively with the customers in educating that while moratorium, if required for liquidity purposes, is available, and there is an opt-out facility for retail borrowers. But at the same time, it is an expensive proposition, and given that proper due education has been given to customers. In April, we had as high as about 35% of our retail borrowers seeking moratorium, which has dipped by June to only about 20%. Month on month, from April to May, the collections doubled. And then from May to June, again, the collections doubled. And from the early trends of the first billing cycle of July, we have 3 billing cycles. The trends are even more encouraging. So I believe, as the unlockdown progresses, as well as customers get a better grip on either their business or on their status of their job, people are willing to continue to service their EMIs. What is also a great distinction is that as a housing finance company, there is an underlying property for each loan that we give out, and there is tremendous amount of equity which is there in each of these loans, and therefore customers' strong desire would be to pay down these loans as fast as possible, which is the behavior we've seen in the past also. So the short answer to your question, collections are doubled from April to May and May to June, and moratorium is down to now about only 20% of the borrowers seeking that as of June. In July, I would expect that number to go down further.
Right. Gagan, are you seeing an uptick in demand as well as inquiries? How have the footfalls in the branches been? Has there been any improvement post the lockdown got lifted?
We are approaching this slightly differently. I think at this point in time, given the macro uncertainties around, which real estate project would get completed, and therefore, even if we have to extend home loans, we have to do a complete reassessment of the cash flows of the real estate project, and to see whether the home that we are financing within the real estate project will see completion and light of the day. We also have to appreciate that construction work still has not commenced on most construction sites, and we will have to wait that out, as well as, SMEs are now getting back to life, so their cash flows have to be reassessed. So in terms of credit demand, if we open up the credit demand book, there will definitely be demand, but I imagine that situation would be more prevalent after about 15th of August in the second half of the second quarter. And as I said earlier, we are looking to get back to growth only in the only October onwards. So I imagine July to September would be a period where we would be focusing more on collections, doing all of this reassessment, making sure that we appreciate the situation of our borrowers enough. And then second half onwards, we look to get back to growth, by which time I would imagine the liquidity situation would also be better and the flows would be a lot stronger. Risk aversion should be lower. The various initiatives taken by the government are already showing some benefit, and that should flow through further. So given all of this, I would imagine some credit growth to come back in the second half of quarter two, but proper growth to be witnessed only from October onwards.
Right. Gagan, your board has also approved fundraising of about $300 million. How is it that you're looking to deploy these funds? And more importantly, what is the fundraising pipeline like for the financial year ahead?
Yeah, so our historical paths of growth has been that we upfront load up equity, make sure that we are extremely well capitalized, such that when we are focusing on growth, that does not come as an impediment. If I look at the last 10 to 11 years, the lowest capital adequacy that we've hit is about 20%. So that's how well capitalized the company has forever been. And that's a strategy which has done extremely well for us. At this point in time, we've taken an enabling resolution from the board to go out there, engage with investors with an enabling resolution in hand, and to see in what structure is it most efficient to raise $300 million of equity. We hope to close this transaction reasonably quickly, so that, again, as I said, from second half, we can focus on growth and not worry about capital or anything of that sort. This is more a buffer capital that we are trying to create for future contingencies as we look forward to focusing on growth. Besides this, I don't see any reason to raise further equity beyond this $300 million. We are certainly also looking forward to partly selling our stake in the UK bank that we own, which is Oak North Bank, and for that we've already appointed an investment banker who's out there, again engaged in fairly advanced stages with various investors. So these are the two equity or equity type plans that we have as far as fiscal 21 is concerned. Apart from this, there are regular bond raising plans and securitization stroke refinance plans, which will go on and which are in more normal course of business.
Okay, sure. What is your total exposure to developer loans at this point? Will you continue to bring down your share of developer financing as well going forward, given that borrower profiles remain weak? And also within retail, what will be your focus area going forward?
Yeah, we have put together a revised business model late last year and have been working towards that, where it is an asset-light business model. It is focused more on securitization and co-origination. I'm glad to observe that, while we've been speaking about securitization for the last many years, and more so over the last 2 years, the regulators have also appreciated the relevance of this as far as the mortgage industry is concerned. You may have noticed last month the regulator put up draft guidelines for securitization, doing a special carve-out for residential mortgage-backed securities. One would expect that the formal guidelines would come through in the next month or so. That should be giving the securitization market a great leg up, which is one of the key strategies that we intend to continue to follow. Co-origination is again something that we are looking forward to doing. We've already entered into one arrangement. We are looking to conclude another arrangement within the month of July and get that operational in August. So retail, and within retail, home loans and loans against properties is something that we will continue to focus on as we have over the last decade. And that would be the mainstay of the business. Developer loans would continue to come down, both via refinance as well as a sort of securitization that we've been doing. And that as a process, thematically, we would want to bring down significantly. We have created a pipeline which is almost $1 billion sort of reduction that we intend to create in this portfolio between now and December. And various types of due diligence activities are going on that front. So as we move forward into growth mode, say October onwards, the emphasis will be to continue to grow home loans and LAP and to de-emphasize on developer loans for the short term. There are several funds who we are engaged with. Some of them have already transacted with us. We're also looking at creating a transaction platform with them for the future developer loans, where only about 20% stays on our book and 80% is financed. But that, I think, will be an activity which we will look at doing in only calendar 21. Through the current fiscal, we will continue to de-emphasize on developer loans, run them down via refinance and securitization, and focus on home loans and LAP. But the balance sheet growth would be only about 8 to 9% annualized, whereas we are looking at an annualized growth rate of loan AUM in the high teens in the near future.
Okay, you mentioned that you're looking at refinancing and securitization of the developer loan portfolio to bring down your exposure in this segment. Have you been able to garner good investor interest on this front? There's heightened risk aversion right now, asset quality concerns for developer loans.
Look at, an year-on-year reduction in the loan book of the company. There is, not year-on-year, but through starting September 18 to date, which has been from a liquidity flow perspective, perhaps the worst period with risk aversion around domestic assets, be it from banks or anyone else, being the highest. Banks were highly risk averse. Non-banks did not have capital to do any sort of refinance. In that sort of an environment, we have, refinanced received back our monies through own sources of almost 46,000 crores. That's a very, very large sum of money in any context. And it represented close to about 42% of our loan AUM. As we continued through this period of moratorium, which again has put up the antennas around credit quality, what's going to happen with real estate, which has been an ongoing problem for the last 4 to 5 years now, concerns around real estate. We were able to refinance through an institutional partner, close to about 2,200 crores, where we've received these monies and we continue to remain engaged with other institutional partners who are conducting diligence. And that's the $1 billion or 7,500 odd crores that I'm talking about. So, yes, there is a risk aversion in the marketplace, but if the assets are prime, they're close to completion. One is well aware that completed homes tend to sell. Early stage construction homes are not selling. So the progress that some of our projects have shown is allowing investors to come in and refinance us. That pipeline is strong and it should continue. We have, over the last 18 months, specifically for developers, been able to refinance something like 19,000 crores of loans, which is also a very, very large number. And these are loans which have been refinanced or securitized in a period which not only was bad for NBFCs, but perhaps was worse for real estate credit. So if one's exposure is good and is to decent names, to decent projects, I would imagine that there is clearly appetite in the marketplace, and that appetite is something that we look forward to catering to.
Right. Lastly, Gagan, asset quality has improved with the gross net NPAs actually coming down by about almost 14% on a sequential basis, and you achieving zero net NPA status as well. Given the kind of tough macro environment that we are currently in, how much do you expect your NPAs to rise before things actually normalize with the economy picking up?
There would be marginal movement up or down in NPAs. It's not with the large provisions that we have created. We've ensured that there is no tear-away rise in the NPAs. We have provisions to be able to take care of that, and those have been created upfront. So they would operate in a range. There would not be any dramatic rise. It's very difficult for me to say whether it will go up 20 basis points or not. That we have to see month on month every exposure. But we would continue to be extremely proactive as far as continuing to create provisions, doing recognition, pursuing recovery. I think that path, we have demonstrated over the last 3 to 5 years that, we have been proactive and we have been successful. Of the total slippages that the company saw, be it in the NPA bucket or the write-off bucket, over the last 5 years, we've already recovered over 82% of that. And given the fact that every loan is backed by security, there is a high probability of recovery. So even if there is a default, the loss given default is minimal, and that's a path that we will continue to pursue. It is better to be proactive in such things, and we will continue to be proactive. The comforting factor here is that practically the entire book has assets backing it. Most of the assets which are backing this book are extremely prime assets, very well-known assets. So I see no problem as far as managing the short to medium term as far as asset recovery is concerned, asset quality is concerned.